This is episode 235 of Zen and the Art of Real Estate Investing with my guest, Mike Madsen. Mike is the Vice President of Acquisitions and Economics at RealSource. RealSource is focused on long-term value and sustainable growth. They have a multifamily track record with over $1 billion in cumulative investments and 6,300 renovated apartments. It's probably way more than that because websites are always out of date. Mike, welcome to the show.
Yeah, thanks for having me. It's great to be with you today and talk some real estate. And I think we can see the horizons of a upcycle coming, kind of depending on the market. So a lot more fun to do a podcast than maybe the last few years. So glad to be with you and talk some real estate.
Yeah, I mean, let's get right into that before we get to your whole background in real estate. Why should we be bullish on multifamily? Because the general news consensus might make people think like multifamily is not a great investment. I think you and I both agree that it's always going to be a great investment, but particularly now there's a lot of opportunity.
Yeah, I mean, people always need a place to live, as they always say. But I mean, even the banks taking back properties from deals bought at the wrong time or in the cap rate bubble, they're not selling real estate either. They're putting asset managers in place, and so unless you're in one of those, say, dozen metros have an oversupply level, we're seeing rent growth return. I think the big story was kind of absorption and how strong the demand side was, but to me, the biggest thing is just understanding the cap rates and we went through 2021 when cap rates were so overvalued, and I think we're going to look back and see 24 and 25 as when cap rates were undervalued. So it's sometimes it's such a big overriding factor, but with rent growth returning in a lot of areas and spreads coming in, I think we're going to really see some good opportunity for rent growth and appreciation in the right markets in these years ahead.
Yeah, and even in those markets where the rent is going down, that really came from just an oversupply or overbuild, right? I mean, it's not like we suspect that people are going to stop moving to Texas. I mean, they're going to keep moving to Texas, so eventually these units will fill up.
Yeah, no doubt. And it was concentrated in a lot of areas, but obviously we've seen the starts decrease dramatically. I think we're down 60 to 70% in most regions. And when those fall offs happen to deliveries, we're going to really see that we're back to a housing shortage, and we're going to see supply and demand drive rent growth again.
And as you said in the beginning, I mean, there's always going to be a need for more housing. It doesn't seem like, even though people aren't having children as much as normal, it's not like there's just a glut of housing in all areas that are available. And especially when people want to move up to newer properties and see the new builds, that's where the trend is for the old opportunities that people end up recycling in multifamily, the buildings that kind of couldn't keep up with the time with mom and pop owners. Those are going to need to get changed over and kind of all redone, which is all part of the syndication process as well.
Yeah, definitely. I mean, a lot of people felt like we are getting a little bit to the top of the market in 2018, or definitely in kind of the later innings of the cycle. And we really highlighted how much of that pent demand is there from, like, at the time, millennials kind of still living at home. And it was just amazing. And that household formation has really drove demand. And obviously, post pandemic, a lot of people moving out on their own was a big boost there, but there's still a ton of pent up demand, and we're going to be right back to a housing shortage, unfortunately. And, you look at so many of these markets to where it just doesn't pencil to build because the rents are so affordable.
Yeah.
And some of these markets are markets that still have strong rent growth and strong job growth, but they just don't have, that level of rents that can justify the cost of construction. So there's, a few markets that are going to really get kind of the best of both worlds here. And we're going to see that demand outpace supply and drive rents again.
For your personal investments, when you're even if you're linking in obviously with other people, do you have a preference between a value add multifamily and something that's not necessarily turnkey, but more like an operational redo? Because there's a different payment plan on both of those if it's a syndication.
Yeah, I mean, I'm really kind of all about the value add. I mean, I underwrite hundreds of deals with our team here at RealSource, and Um, Really what's kind of losing out right now is returns. I mean, that pendulum is really stuck a little closer to the sellers, and everybody's holding, and it seems like most of the time the only people are selling are the people that have been in it a long time or have to sell. And so it returns are tighter than they've been, and people are prudent as we've kind of come out, and a lot of people have been burned. So I think a lot of that's for good reason. But to really get the attractive returns, it's got to be value add, and I'm like to focus more on the interior value add process. And if you can buy a couple hundred units where there's demand for turn a 1980s kitchen to a modern kitchen and get the carpet out and get the right flooring in and get hard surfaces, you're not resurfacing, and earn that higher rent by making it a nicer, cleaner place to live with good services. So yes, I'm all about the value add strategy, but I think you got to be careful with those sponsors. I mean, I remember jumping into value add early 2011, and by 2018, every deal that hit the market on or off market because it was a value add, right? So 95% of what the new new tax rate's going to be, whether it happens in year 1 or year
Yeah.
5, and it's a little bit of just hit and miss on that. But I mean, I guess my advice to those that are just jumping into it and looking to go with sponsors and find that passive income and cash flow is kind of, as they say, you know, put faith in the jockey, not just the horse, and look at the sponsor and look at their track record. Um, Look at their history of real estate owned, and don't get over focused on the returns, because sometimes, and you know this, but if you're not a prudent underwriter, it's easy to put out a 20 IRR. But well, I'd really just stress that and a lot of people probably know this and have been through it and learned in the process. But if you're new to it, just really be careful of who your sponsor is, how they do business. The number one thing to me is, what is your basis? What is your LTV, and what is your debt structure?
Yeah.
And I think if a lot more people were focused on that, there'd be a few more success stories than we've seen in the last few years. But what a great time to get in. I mean, if you look back at, like, obviously what we're going through and went through is not 2008, 2009, but right now it does still kind of remind me of that kind of 2013, 14 kind of opportunity. I don't think people knew at the time how great a time it was to get in.
Yeah.
I think in a few years, we're going to look back and say, yeah, as long as if you are in these top 10 markets, this is the bottom and this is the time to get in. But at the same time, the rent growth and outlook is so bifurcated because of the supply concentration that it is kind of hard to paint it with a broad brush sometimes.